Let's talk about gold. You know, it's a word that pops up in pretty much any conversation about money, about wealth, about feeling secure. We see it as this ultimate sign of prosperity, this safe place to run when things get chaotic. But what if the way most of us think about gold is, well, just fundamentally wrong? What if it's not about getting rich at all?
I mean, this is the big question, isn't it? When we buy gold, are we really buying a ticket to future riches? Well, the surprising answer, based on the analysis we're diving into today, is a pretty clear no. And the reason why is actually fascinating.
And this leads us straight to the heart of the matter, this huge misunderstanding about gold. We've been taught to see it as a way to create wealth, but its real job in our financial lives is something else entirely.
Right, so this is the piece of common wisdom we're going to challenge. So many people think, okay, to grow your money, you buy stocks, you buy real estate, and you buy gold. But the argument here is that gold doesn't even belong in that category. It's playing a completely different game.
So if gold isn't about growth, then what is its purpose? Well, to really get it, we need a simple, but honestly, a really powerful analogy, and it all has to do with a ship.
Okay, so this is the key phrase right here, a wealth preserver. Imagine your wealth is a ship on a long journey. Now, over time, a tiny little leak appears in that ship, and that leak, my friends, is inflation. It's slowly, quietly draining your purchasing power. A wealth preserver doesn't make the ship go faster. Its job is to plug that leak.
And this line just nails it. Gold isn't the engine. It's not the sails that are pushing your financial ship forward. It's the simple but absolutely crucial plug that stops you from sinking. Without it, that water, inflation, just keeps pouring in.
Now, check this out. It's really interesting when you see how cleanly we can separate these two roles. So on one side, you've got your wealth creators, things like stocks, right? They represent ownership in actual businesses that grow, they innovate, they generate cash. They're the engine pushing your ship forward. And then on the other side, you have gold. It doesn't grow, it doesn't produce anything, it just sits there, holding its value, and that's how it stops that inflation leak. Okay. The ship analogy is a great story, it makes sense. But do the actual numbers back it up? Let's put this whole theory to the test. Now, this chart might look a little complicated, but the concept is simple. It's showing something called rolling returns. Just think of it as a way to average out performance over long stretches of time. It lets us ignore all the daily noise and see the true, stable trend. And what do we see? Remarkable consistency. For more than a quarter century, gold's returns have just kind of hovered in this pretty stable range. It's not explosive growth, it's just steady.
But a stable return is great and all, but why is it stable? If that return isn't coming from business growth or dividends, where is that 8 to 12% coming from? Well, the next slide has the answer.
And here it is. This is the big reveal, folks. The top line shows gold's returns, and that bottom chart, that's the rate of inflation, what we call the CPI. Just look at how closely they mirror each other. When inflation goes nuts, gold's returns tend to rise. When inflation cools off, gold's returns follow right along. They are practically moving in lockstep. So here's the bottom line, the crucial point of all this. The return you get from gold isn't really a gain in value. It's really just a measurement of how much value your currency has lost. Gold is simply keeping pace with inflation. It's preserving your purchasing power, not creating new wealth on top of it.
To really let this idea sink in, let's just do a quick, simple thought experiment. I want you to imagine a world where inflation just doesn't exist, gone.
So picture this. Your salary is paid to you in grams of gold. And everything you buy, your food, your rent, your clothes, it's all priced in gold. Now in that world, would you ever need a yearly raise just to keep up? No, of course not, because the value of your money and the cost of everything else would be perfectly locked together. Your purchasing power would stay exactly the same year after year after year. And that little experiment just brilliantly illustrates gold's true nature. It's a stable reference point for value. In our world, where currencies are constantly inflating and losing value, gold acts as this incredible anchor, reminding us what real, stable purchasing power actually looks like.
Okay, so if gold isn't going to make you rich, what does this all mean for your money? Where does gold actually fit into a smart financial plan?
You need to think of gold not as your main engine, but as your safety equipment. It's your hedge against the really extreme stuff, currency chaos, geopolitical crises, you name it. It's your financial shock absorber for when the road gets really bumpy. It's there to give you resilience, not speed.
So, how much of this safety equipment do you actually need? Well, the suggestion from the source material is an allocation of around 5 to 15% of your portfolio. That's enough to provide that shock absorption to act as that hedge, but not so much that it's going to hold back your overall growth.
And this brings us right back to our ship analogy one last time. Think about it. If your entire ship was made out of that plug, it would never ever sink from the leak of inflation. That's true. But it would also have no engine and no sails. It would just sit there, afloat, never moving toward your destination. You have to have those growth assets to actually make progress.
So the next time you think about gold, or maybe even gift it to someone you care about, remember what you're really holding. It is not a lottery ticket. It is something far more timeless. As the source so beautifully puts it, you're gifting a wealth preserver, a tool designed to protect value across generations. And you know what? Understanding that difference is the real key to using it wisely.